Trevor Greetham, Portfolio Manager and Asset Allocation Director at Fidelity International, joins us now. How, Trevor? Got to start with Paul Krugman. You were nodding and agreeing. I mean, are we in the early throes of a third depression? That's pretty gloomy stuff.
I don't think we are. Actually, the thing I think Krugman hit the nail on the head with was his description of what's happening in Europe as fiscal masochism.
Yeah.
So if you're in a fixed exchange rate regime, like a lot of the Eurozone countries, you slash fiscal spending, you can't cut interest rates, you can't devalue, and there's a big problem. And I think the spreads that are widening in Spain and other countries in Europe are telling you that growth is slowing. They're not saying, please cut spending. It's a simple slowdown, like the drop in the bond yields, like the weakness in the stock market. But I don't see a depression, because the money printing we got a year ago certainly worked. And I think central banks will have to step in later this year
more QE,
and print even more money.
QE, really?
Rate cuts where they can do it, more QE. I'm certain
where they can do it. I mean, UK is pretty limited, isn't it? But could the ECB go lower than 1%? Should it go lower than 1%?
Well, I don't know whether it matters so much whether it's interest rates or QE. There will be more QE from the Bank of England, I'm convinced of that. And this will set us up for a good year next year. And what's funny is we're right in the middle of 2010, and it's an even-numbered year. And there's been a simple rule for your viewers for the last 10 years or so. Even years bad, odd years good.
Okay. Actually, so how do we set ourselves up then for 2011?
It's an inventory cycle thing.
Right.
So it's a 2-year cycle. So it so happens that the odd-numbered calendar years have all been the recovery years, like 09 or 03 or 99, and the even-numbered years have been the inventory gluts, the slowdowns. And as a result, if you look at the world stock markets, it's up 60% since January 98.
Of course.
On average, in the even-numbered years, or cumulatively, it's down 35%. In the odd-numbered years, cumulatively, since 1998, you're up 140%. So just trade once a year on the 1st of January.
You're fine.
And you've heard it here first.
Talk to me about where you're putting your money, Trevor. Your neutral equities, moderate overweight property and government bonds, underweight commodities. Give me your thinking.
Well, I'm sort of moving from a position of being overweight the riskier growth-sensitive assets, which we moved into in the spring of 09. So I'm beginning to underweight things like equities and commodities and property in the multi-asset funds I manage. And I'm sort of shunning Europe, so I'm underweight Euros, underweight Europe, and really sort of favouring America and the emerging markets. And I think America may end up benefiting from the Europe crisis in the way that America benefited under Greenspan from the Asia crisis. So they're not cutting budgets aggressively. The Fed is ready to print money where the ECB might not be ready, and I think America will benefit.
So you're just not buying into this argument, the Merkel argument, the UK coalition argument that we need to address our deficits because that'll instill consumer and business confidence. I mean, does that work on any level or not?
Well, kind of. I mean, I'm more relaxed about what's happening in the UK because the Bank of England can print money and sterling can and will devalue. And that will give us a good offset. So I think we have other policy levers. So I'm not too concerned about that. But I do think the best way to get growth is, the best way to get sort of debt reductions is through growth. And I think the leading indicators for growth are peaking. So now is a very, very bad time to hit the exit button, which is what Europe is doing.
Bonds, you say your moderate overweight government bonds. Where can we take advantage of what's happening in the global government bond market?
Well, I think it's I'm more overweight bonds as an asset class generally. I'm certainly not overweighting the peripheral European bonds.
Sure.
So within Europe, it would be German government bonds. I mean, they yield almost nothing, but and actually within European equities, I also prefer Germany.
Yeah, I mean, on the first day of the second half of the year, Trevor, I mean, you're looking and sounding pretty relaxed amidst all these fears. Is that what you're feeling inside?
Yes, well, I'm not surprised the markets are weakening because we've seen the growth lead indicators peaking out. I mean, things are so good they can't get better in terms of growth rates. So weakness is not surprising. We need to get the central banks to print money to get us in the next upswing. And it might be 6 months away. But the point is I'm sort of selling to keep powder dry, wanting to buy later in the year. And I think it is a multi-year recovery because there's plenty of spare capacity, there's no inflation, and central banks will keep printing money.
Trevor, thanks for joining us.